Hi everyone, hope you're all doing well. Today we're going to talk about an individual stock. We haven't really talked about that many individual companies recently. We've not really took a big deep dive into a stock, but you know what? I thought today I'll talk about this one because it's one that I'm watching and it's also been a very talked about stock on the Discord as well. So hope this video is useful. It's a UK stock that has been absolutely killed in this year alone and since its IPO actually. And when you look at the S&P 500, obviously great year in the US markets, but when you start looking at the UK markets, it's a total different story. If you look at the FTSE 250, year to date down 2%. If you look at the AIM, down 13% year to date. Can you believe that? Imagine if you were just investing in the AIM index. There's been some stocks that have rallied up in there, but there's also some stocks that are still massively beaten up in there, and that's what we're going to look at today. And if you look at the likes of Burberry, for example, we've been mentioning this one a little bit on the Discord recently, and it's a bit of a iconic British luxury fashion brand, and year to date this is down 26%, and if you look at since the early part of 2023, it's down 41%, and a few people are thinking, is this an opportunity to get into Burberry? Keyword Studios, I mean, this has been one of the gems of the UK markets. This has been one of our best performing stocks in the UK market, and even this one in the last year to date is down 52% year to date. And today we're going to look at another iconic luxury fashion brand in the UK, which is Martens. Now, one of the reasons why we're looking at this is that obviously a lot of these UK stocks are still massively beaten down and could be good opportunities, and another indication of why that might be, and I actually think Martens could fall in this category. I think we could see maybe a US fashion giant actually look at Martens and go, you know what, we won't mind actually buying that one up. We've actually seen a few UK companies actually get taken out because they're looking so cheap. You know, you look at Hotel Chocolate, bought for 160% premium by Mars. You know, that's an indication that some of these US companies are going, look at the UK market and look at some of the really recognised brands out there and how low they are. And I do think Martens could be in that category. I don't, and I won't say buy that stock because it's going to get taken over. You should never do that. You should never buy a stock in the hopes that, it's probably going to get bought out. But I do feel like Martens could fall in that category. And we have talked about Martens before. We talked about it around about 10 months ago, and the stock was down 30% at the time, and I made a video saying, is the stock a buy? I said on that video that personally for me, I would not buy that stock right now. I would give it a little bit of time, and that proved to be the right decision, because obviously since then the stock is down 53%. So that was a good decision on that video to make that call. Obviously, you know, we got a right call there, and it's never been brought up since. But honestly, you know, you bet you, if I bought that stock would have been mentioned in every comment section of my videos for the next year, and it'd probably be mentioned for the next 3 years in my comment section. You know, you never get the credit for the ones you get right, do you, on YouTube? It sums it up perfectly. But anyway, enough of that. Getting on to Martens. So I actually really like this from a brand point of view. You know, I like buying great brands, and I think Martens is that. I think when you look at Martens, I think 10 years time, is it going to be around? And I think so. I think we'll still see people wearing Martens in 10 years time. And when you look at the brand's history as well, it's got a mega history really since like 1960. We've always seen the cycles of fashion come back around to Martens. Now, granted, this is only a little thing when you get into a fashion industry or a fashion stock. It sometimes is the booms and the busts, and I do feel like we have been in a bit of a boom for Martens in the last kind of couple of years, and I do feel like the popularity has come down a little bit at the moment, and there's going to be waves with this sort of brand. But saying that, is it starting to get priced in? And if there is going to be a next wave where Martens becomes popular again, will this then turn out to be a good investment? And when you start looking at the company now, obviously, IPO'd in 2021, down 81% since its IPO, does pay a dividend of 6%, and it does trade at 18 times earnings of the last 12 months numbers. Now, when we start digging at the financials, you'll be able to see here that the company has had that surge up through the revenue and profitability. Now, the company did used to struggle a little bit with the profitability side of it, but it has started to come on massively. What has really helped that is Martens has started to focus on D2C and the big boom that we talked about, but also it's D2C. D2C is a lot bigger, a lot more profitable for the company. cuts out the middleman. You make more profit when you sell the the products, and that is why the profitability has started ramping up on the company. But as you'll be able to see here, when we look at future growth, you'll be able to see here there has been a bit more of a decline recently in the financials, and that's what's causing the dip. Now, the big thing is analysts are forecasting for the company to go back to revenue and profit growth, which we will talk about in a little bit. And if you do go a year out on the numbers for March 2025, you can see here the company is actually forecast to be trading around about 8 to 9 times forward times earnings. Now, what we have with Martens is, if you look at the balance sheet, I actually wish this was a little bit better, and I thought it would be better for a company that recently IPO'd. 86% debt to equity, and you can see here the cash is around about 45 million, and they do sit on 314 million of debt. So obviously when they go to refinancing some of these costs, that is around about half the market cap. And I do feel like with Martens, this does not actually get talked about that much, is the balance sheet. Unfortunately, when you have these high interest costs, this is going to be taking your profitability down, which we are starting to see here a little bit at the moment. So that's a little bit of an issue that I feel like doesn't get mentioned that much. And if you were to look at something like a Burberry, for example, I'm pretty sure that they have a clean balance sheet, which is a little bit more tempting as an investor. Now, like we said, they do pay a dividend, and it does sit at 57% payout rate. There is also insider buyers going on during the summertime. So you can see here there was the CEO that bought quite a few shares actually. There was also a member of the board of directors that bought a couple of shares, and also the lead director as well bought some shares. Now, the actual CEO actually bought around about 400,000 worth of shares, so that's actually a really big pickup as well when you look at that point of view. Now, when you look at the recent half-year report, you can see what is going on inside Martens. So you can see they opened 25 new stores. Obviously, that's them having more of a physical location presence and also increasing that D2C, and launched a UK repair services. The Doc's strategy of brand control, so obviously clear, once again they're focusing on the D2C and prioritising more profitable sales via our own stores and websites, continue to deliver with direct consumer revenues up 11%. So they're focusing still on profitability and having them direct sales and cutting out that middleman. And you can see here that they're doing that by owning even more stores. And that's actually growing 11%, which is actually really impressive because that's what you want to see growing. Now, I said here, the US is where the increasingly difficult consumer environment is. Now, this makes sense because you look at Foot Locker is saying exactly the same thing. US is weak at the moment. So it's not just a Martens thing, it's clearly a US thing, and a lot of US companies are having it. So maybe that this starts resolving itself in the next few months and years. So that's clearly what you need to be looking at. You need to be looking at the improvement in the US sales. That's what's the key thing here. Now, when you look at revenue was down 5% on a constant currency. It's actually on down 3%, which isn't too bad. Direct to consumer revenue mix was actually up 7%, which is obviously really good. But the big thing is profit before tax was actually down 55%, which was a little bit disappointing. The EMEA growth was up 9%, and strong performance in Japan as well, up 41%. America revenue was down 18%. So once again, this is what the big drag on the company is at the moment. The US sales are poor and they need to come back at the moment. That's what we're looking for. Profit before tax was down 55% to 25 million, reflecting the EBITDA performance together with higher depreciation and amortization as a result of continued investment into IT products, DCs and new stores. So it is saying that there was also some money put in here to improve in the business, which is to bear in mind. You can see here the increase that did not happen on the dividend. We got no increase in that dividend. So looking at Martens, obviously, they are prioritizing D2C and using that brand, which we want to see. UK, European sales, Japan sales look good. Clearly, the sales that are struggling at the moment is the US sales, and maybe that is a bit of fashion trend. Maybe it is that we've seen a lot of other companies like Foot Locker say the same thing. But I think we do need to see the improvement there for this to come about. Now, you can see here analysts are forecasting for that to happen, and they are expecting that improvement. And if that improvement does happen, that'd be very good numbers that they're putting in at this sort of valuation. But for me personally, I would wait to see this US performance start recovering before buying it. Now, I think it's a great brand and at the right valuation, as well as that, 6% dividend yield as well. I think this could be a buy. I would personally say that, the perfect combination for me would be to see Martens maybe drop another 20%, maybe if we can get Martens towards the 70-80p range, and then we start seeing the US growth start coming back. And as soon as we see that growth coming back, because if this company can go back to, I mean, analysts here are forecasting nearly a 7% increase in the revenue and then a 3-4% increase in the revenue. I mean, realistically, that's all that that's all that needs to happen. And the profitability, if they can start coming back from some of the costs, managing the debt down potentially, it could do quite well. I mean, if they're throwing off 100 million nearly in profitability a year, it would not take them long to start paying down their debt, which is probably one of the big concern that I have with it. So I actually am really watching it. This is on a watch list, and I'm not close to buying it at the moment, but I think this is one that I can come back to in maybe another 6-12 months. And if the valuation is ideally a little bit cheaper and we're starting to see the comeback in the US sales, it could be interesting. But there's still improvements to have. But if they can keep ramping up that D2C part of the platform and they start getting the benefits because they'll be more profitable and then the revenue starts going up, it could be interesting. So this is one that is on my watch list for 2024. And like I said, it's one to come back into 6 to 12 months time and see if the improvements are happening and that D2C really does pay off for them and the new stores pay off for them. It could be an interesting one. So for me, not a buy yet, but it's one on my watch list to come back into 2024 and I could be a buyer. So we'll see what happens. I'm a lot more bullish on this one right now than where I was when I made this video 10 months ago for sure. So that's what I'd say on that. Hope you enjoyed the video, guys. If you could hit that like button, if you're not here, subscribe. Hope you enjoyed the video on Martens. See you in a bit.